Chirag Setalwad of HDFC MF spells out his outlook on Indian equities and sectors that you need to watch out for.
Few data points in India have also changed positively. One is, of course, the new RBI governor, and he's made some positive announcements. And there is an expectation that he will make more. So I think that is one, to see a fresh face at the RBI has been positive. We've also seen IIP numbers which have been a little bit better than expectation. So an anticipation or expectation that things could improve from here. So things have changed in India as well, but these are first very early signs. So I don't think one should get too carried away with them.
So are these green shoots or yellow weeds?
I'd like to think that they are green shoots, but I think it's early days. I think we need to see more data points. We need to have more conviction. I think if one had to categorize it, I'd say it's very early days and therefore very young green shoots. So I would not get too carried away.
So the script of how Indian markets have moved in last 2 years is a function of liquidity, largely global liquidity. What you mind could influence the script in the short and the medium term?
I think in the short term, if you look at it from a 6-month perspective, obviously the elections will be a big factor and how that plays out. So if you have a strong government, either whoever the party may be, I think that will obviously be viewed positively. If not, the market will certainly react negatively to a weak coalition format. What the Federal Reserve does internationally in terms of tapering, I think that is obviously topical, and that is something which will ease off possibly by the end of the year. So I think that will have some impact on markets. And I think these are two important variables. Of course, we'll have to see how monthly data pans out in terms of IIP numbers, etc., to see how economic data pans out. So I think all of these things will influence the short-term movement in the market. So there is plenty of news flow.
What's your take on rupee? When we started the year, there was a print of 55. It came down to 69. Now it is 60. How does one judge where rupee is headed?
Clearly there's been some issues on the current account, which drove the rupee from 55 higher. But there is also a lot of sentiment which goes into it. So I suspect at 69 there was a lot more sentiment at play and not as much of fundamentals. I think at these levels, I probably think the rupee is a little bit undervalued. So you could see the rupee strengthening a little bit from here. I think the negative sentiment has eased off to some extent. You should see the current account improving because on one hand, India as an economy is slowing, and as a result imports should come down. On the other hand, the rupee has weakened, making India more competitive, and therefore exports should pick up. So there should be a natural correcting mechanism in terms of the current account deficit coming down, and that will ease the pressure on balance of payments, that will ease the pressure on the rupee. So I think there is some fundamental justification for the rupee to strengthen. There is also some emotional justification for the rupee to strengthen as well, simply because sentiment has been so negative. While it has improved a bit, it is probably still by and large on the negative side. So some strengthening, and so you may see the rupee drop below 60, but I don't think much below that will happen. But very difficult to predict. I don't think at 55 we would have predicted 65. So we are a little bit wary at 62 predicting where it's going to go.
So it's too early to judge whether the worst of the macro is behind us. I mean, according to you, we may be or we may not be close to an economic bottom.
I think so. I think it's early days. We still have to see. I don't think we have conviction yet that we are out of the woods.
So what are the landmines right now?
The landmines have been well highlighted in terms of poor infrastructure, poor decision making, high interest rates, poor sentiment. So these are all well-known concerns, and some of them are improving. So the government is becoming a little bit more active in terms of decision making. Unfortunately, it's not enough. We need to see a lot more. Some projects are being released, approvals are happening, but once again, approvals is stage one. Next, you need activity on the ground. So again, it's early days.
Do you think the current account deficit, CAD, the most dreaded word for Indian financial markets for this calendar year, is yesterday's story now?
I don't think it's yesterday's story. I mean, the fact that you and I are talking about it means it is not yesterday's story. But I think we should remember that while today we are obsessed with what is happening to the rupee and the current account deficit, 2 years ago we were obsessed with what was happening in Greece. And 2 years before that we were obsessed with what was happening in the financial crisis. And 2 years before that it was something else. So the the key concern of the day changes, obviously. So I think if I had to guess, 2 years from now, it will not be the rupee. We will have a whole new set of concerns which will be preoccupying the market. So today it is certainly the most sort of tracked variable one can think of. But I think 2 years from now it will be quite different.
Chirag, whatever could go wrong, some would argue has already gone wrong for India. Rupee has fallen, GDP growth has contracted, earnings are not expanding, they are contracting. We've lost a lot of investment opportunity. But markets are still at 20,000. Sensex is what? Less than 2,000 points away from an all-time high. Are you surprised with the resilience?
Yes. I think the market has proved to be much more resilient than the fundamentals would suggest. But I think the thing to keep in mind, and this has been pointed out by many, is that the market is certainly polarized. Because you have on one hand high quality, large caps, particularly in sectors such as FMCG, which are very expensive and probably close to their all-time highs in terms of a valuation standpoint. And then you have sectors such as capital goods and banks, which are extremely attractive. So the market is certainly barbelled in terms of how the valuations are stacking up today. So the 14 average multiple which you see for the market hides the fact that there is some things which are very expensive and some things which